Thank you all for joining us this afternoon. My name is Andrea Judd. I'm a program manager at the Council of Michigan Foundations, and we're really pleased to have you all join us here today for this, this exciting webinar on Washington and tax policy. We did want to let you know that if you have any technical trouble during the webinar, you can reach out to ReadyTalk. They are very helpful and responsive. They can be reached at 800-843-9166 or help@readytalk.com. And just to let you all know that because of the number of participants that we have on the webinar today, we have muted all the lines during the program. But we do want to hear your questions, comments, or anything else. So please feel free to use the chat box that's on the lower left-hand side of your screen, and you can chat in questions. We'll be stopping at various points throughout the webinar, as well as have some time for Q&A at the end of the webinar, and our speakers will respond to your questions at those points. With that, we have two really wonderful speakers today. Rob Collier is President and CEO of the Council of Michigan Foundation, and Donna Marie Brown is President and CEO of the Michigan Nonprofit Association. So at this time, I'm going to turn it over to them for some introductions.
Okay. Well, thank you, Andrea. And this is Rob Collier. And I want to add my thanks, our thanks to all of you for joining us. I'm indeed, as Andrea said, it's sometimes hard to get excited about tax policy. But when you think about all the implications for our charitable sector, this is a huge, huge time for us to be engaged in exploring these issues. So with me is Donna Marie Brown, President and CEO, and Donna joined, and her colleague Joan Gustafson joined CMF for our 35th annual visit to the Hill in March. And we learned a lot about, the implications of the new Tax Act. And we also learned that a lot of questions were still unanswered. So in response to emails and inquiries from members, we really wanted to launch this webinar today as the first of what will probably be a series of webinars to dig into some of these issues in greater detail. And I'm really excited that we'll be joined by a special guest when we get into that wonderful subject of UBIT. So with that in mind, Donna, would you like to just say a few words? We're thrilled to have you on this webinar. Thank you so much.
Well, thank you, Rob, for having me. This is exciting, and as you said, we rarely get excited about tax policy, but there's so much that's happening right now and so little that we know we're monitoring on a regular basis, but it's great to be able to dig in on some of these subjects right now, so anxious to get started.
So in terms of our agenda today, let me just share with you kind of the broad topics that we want to cover. So we'll move to that slide next, and let me Andrea, are you there? There we go. All right. Okay. So we're going to spend a few minutes on charitable giving because we've got a lot of inquiries about the impact of the new Tax Act on charitable giving by individuals and also the impact of it on charitable giving by foundations. Donor-advised funds are becoming a hugely important giving tool for the country and for Michigan, and so we're going to talk a little bit about the implications of donor-advised funds. And then we do have some new taxes on the charitable sector, and so we're looking forward to getting into those. And then the last thing we want to introduce you to, and we'll be having more webinars on this subject as well, is the issue of the opportunity really posed by qualified opportunity zones. So we're going to pause, as Andrea mentioned, as we go through the agenda and look forward to your questions, your feedback, because CMF and M&A both have been asked by our members to monitor the situation and try to provide you with helpful information as we learn about it from Washington. So we're looking forward to your comments, questions, and how we can make sure that we're on top of the situation. So let's get started and spend a few minutes on charitable giving by individuals first. Because as you may recall, there's been a lot of talk and a lot of discussion, surveys, studies have been done. And Donna, why don't you lead us off on this slide, okay?
Sure, I'd be happy to. So I think we know that the standard deduction has been increased to the tune of $12,000 for individuals. And it has really been something that's caused quite a bit of anxiety for a lot of nonprofits as they begin to try to plan and understand what this means in terms of giving to their organization. What we found in speaking to some of our members has been for those that are larger organizations that may have fund development people on staff, that they're looking at unique ways to try to figure out if the giving to their organization is going to go down. Largely, the country has stated, in terms of research that's been done, that we're probably going to lose between $12 billion and $20 billion in giving to organizations. And so as they start to try to plan, it's been really difficult to be able to do so. One of the things that I know we're going to talk about in terms of messaging, one of the things that we really want to get away from is, because we've been talking about the standard deduction and perhaps that funding may not be as strong as it was at first or in the beginning for organizations, but we really want them to not think about the deduction itself, but really think about how to position themselves around the impact of their organization and the great work that they do. So this has been a shift in thinking, although we think that the deduction has been a great vehicle for providing incentive to give, but it is not necessarily the sole reason why a person gives to an organization. So at this point, we're monitoring that. We're taking a lot of information from our members. We're also working with our foundation partners to see if there's information that they've been hearing. But the reality of it is we've only had what we consider to be strong assumptions that giving will be less, as I mentioned, to the tune of $12 billion to $20 billion. But the jury still remains to be seen, and we won't know what the impact actually is until the next year in 2019, the next tax year.
And Donna, maybe I just comment on as well. We know that fewer Americans are going to be itemizing, and we will get in, when we get into donor-advised funds down below in a few minutes, we'll talk more about this. But clearly, many folks have always waited till the end of the year, and it's like, okay, it's time to take advantage of the charitable deduction. But one of the trends that I heard about, that I've seen some new data on, is that more and more nonprofits are promoting monthly giving, so that we're seeing more giving on a monthly basis. We were asked when we were in Washington about what does this mean for jobs, and particularly the impact on nonprofit jobs. And I think all of you on the phone know that the charitable sector in Michigan, based on the research that Public Sector Consultants does for M&A and CMF, employs over 450,000 people. And nationwide, 1 of every 10 Americans works for a nonprofit. So we had a professor, George Washington, do some initial research, and what he found, based on this projected number that Donna just shared with us, is that we could see a reduction in jobs of 220,000 to 260,000 jobs, along with this decrease in giving. So Donna, you mentioned the importance of messaging, and one of the things that we are already seeing take place in Michigan and across the country is this giving strategy of using your donor-advised fund to front-load your giving. And someone called it bunching. And so we're going to be doing another webinar just on that strategy alone as we gather more data. But what we've seen is that some individuals, with the help of their advisors, are being encouraged to put money, into your donor-advised fund, a significant chunk, and let your donor-advised fund be responsible for your annual giving for the next few years, and then do it again in order to take advantage of the charitable deduction. You can get up high enough to do it. I think the other thing that, as we all know from Michigan, when Dave Camp was in Congress, one of the things that he played an incredibly important role in helping us all get put in place is the IRA charitable rollover. And what we want to just note here is that it remains intact. You don't, it isn't part of the charitable deduction issue, and so for Michiganders that are 70.5 years old and older who need to take that required rollover from your IRA, this is a really important giving tool, and we're seeing a lot of Michiganders use it. But before we move on this, we need to talk a little bit about the momentum or the discussion going on around a universal charitable deduction. And Donna, why don't you chime in on that?
So it's going to sound like I'm talking out two sides of my mouth. I talk about not so much the tax deduction, that's not important. We should talk about the impact, right? And now I'm going to tell you how important it is to have the deduction there. And there's been momentum that has been built up around the universal charitable deduction. And this is great because we know, as you stated earlier, Rob, that there are fewer itemizers because of the standard deduction being higher. In this case, the universal charitable deduction provides that opportunity for everybody, right, to be able to give. And there is some research that's been done that says about $18 billion might be back into the system, the charitable giving system for nonprofits, and so that's a good thing. So we know that just last week that there was legislation introduced by Representative Chris Smith. I believe he's from New Jersey, and then Henry Killer, don't know if I'm pronouncing his last name correctly, in Texas. For those who want to do some research, it's House Bill 5771. But it's being reintroduced to actually have this available so that everybody can give, and so this is something we should be rallying around. In fact, I think independent sector, who also provided some information in detail around this, that it's time to get the pom-poms out. It's time to start celebrating because this provides an opportunity maybe to mitigate some of those losses that we anticipate with the standard deduction being increased.
Exactly. So we'll keep everyone posted on this bill that was introduced just recently, for sure. And as Andrea mentioned when we got started, please feel free to use the chat service because there's so many of us on this call today. If you have any comments about any of these points or have any questions or see a need for further information, don't hesitate to use the chat service and pose a question to us. So we've talked a little bit about charitable giving by individuals. The next slide we want to go to is really what's the impact on foundations, both private and community? And there are 5 bullets here. The initial legislation last December, when it was came out of the House of Representatives, was going to impact not the payout by private foundations, but was going to impact the second bullet, which is the simplification of the excise tax on private foundations. That did not happen, so there's been no change in payout, and the excise tax formula, which is simplification of it, has been a long-time goal of ours to a flat 1%, is still proposed in a bill called the Charity Act. And we're still hopeful that we can get that job done. We came very close in the last Congress. We almost got it simplified, but we lost by 8 votes. So we're still working on that, and there is bipartisan support there. The other question that came up was, okay, is there a required payout for public charities? You know, as we all know, private foundations have a required payout of 5%, and many people said to me, well, are they going to require a payout by public charities? And the answer was that it's definitely something that they're looking at, but it's not in the new Tax Act, and it's not been proposed at this stage of the game. The last 2 points we want to mention on this slide, and I'm going to turn it to Don in just a moment. We're going to get into donor-advised funds in just a moment, and clearly, as we know, donor-advised funds have been growing rapidly throughout America, throughout Michigan, as a very popular giving instrument for individuals, families, and for companies as well. And so we'll talk a little bit about those in just a moment. But Donna, one of the questions I've been asked, and I'd love you to comment on it as well, is, okay, corporate America's gotten this magnificent tax break. is there going to be more charitable giving by companies as a result? I mean, can we expect to see, will there be more pressure on them to be corporate grant makers? And I'd be interested in your thoughts and reflections on that.
So yeah, it's interesting. When the tax reform first came out, there were lots of corporations that were taking the benefit of having more money in their coffers and providing it to their employees, which is a great thing. And we thought that was wonderful. But then we wanted to track to say, what is that going to mean for nonprofit organizations? Does that mean that now you might be not needing that tax benefit, so you might not be giving to nonprofits anymore? So there was this anxiety. However, I have done a bit of informal research, let's say.
Good.
And what I found is that actually corporations are continuing to be quite charitable. They are still concerned around being good corporate citizens, especially in their community. So it's very important for them to maintain that. And they're looking for opportunities to do that, just that. And quite frankly, one employer in the financial services industry also mentioned that their corporations are made up of employees, and employees are attracted to working with those organizations because of what they do in community. So they don't want to pull back the reins. I mean, it's just this way of kind of balancing how do we attract new talent to our organization, how do we become and stay good corporate citizens, and they still find the best way to do that is through their charitable giving program. So there is not a sense of it declining, but of course we're still monitoring that, and we're feeling really optimistic, if you will, about that.
Good. Well, and that's what we're hearing from our corporate members as well. And you make a very good point. Their employees are expecting them to be good corporate citizens, and it's all about retaining talent in Michigan. So I think we can see, a good trend in that area. So as we move on, we're going to talk a little bit more about donor-advised funds, but I just want to remind you that if you have a comment, or Andrea, has anyone offered a comment in the chat room yet?
Not yet.
All right. Well, please raise your hand if you want to ask about anything or add a comment. We welcome your thoughts. But let's move on and spend a few minutes now on donor-advised funds. And we are very fortunate in Michigan to have a number of experts on donor-advised funds in our membership at CMF. And I wanted to just offer some comments here because when I was in Washington a couple of weeks ago, I met with Treasury again. And Treasury issued a notice for comments on donor-advised funds. And when I met with them a couple of weeks ago, they said that they're expecting to issue one more time notice for comments. But when this next notice comes out, we're going to be looking at regulations on donor-advised funds. And as I mentioned earlier, we've seen this incredible growth of donor-advised funds. I mean, I think everyone on the call knows that the largest charity in America is now Fidelity Charitable Services because they have over 90,000 donor-advised funds. And for us, we used to be helping individuals, families, and businesses create foundations. Now we help create donor-advised funds, particularly in partnering with our community foundations. So there's three bullets here that I just want to comment on briefly and things that we need to keep an eye on. The first one is what we've learned in Michigan, and I'm going to go kind of work from the bottom up, but what we've learned in Michigan is that donor-advised funds can be very helpful in helping community foundations or other sponsoring organizations really be responsive to emerging community needs. I mean, I know that when we went through the economic downturn a few years ago, donor-advised funds on both sides of the state and up north as well were very helpful in providing the resources for emergency funds to respond to community needs. So that responsiveness and that access, I think, are two critical things that we need to tell our story to about donor-advised funds with our members of Congress and policymakers in Lansing as well. The interesting thing, and I say this tongue-in-cheek, but I was asked by one member of Congress, not from Michigan, fortunately, but they said, well, you really run a warehousing association. And I said, excuse me? And they said, well, yes, you're warehousing funds. And I said, no. And so one of the things I found in dealing with some of the policymakers is that they truly don't understand the value that donor-advised funds provide to their communities. So that issue of warehousing, it still remains as something that we have to explain to them, that yes, the donor gets a charitable deduction, but the issue there is that the funds are being put to good use to respond to community needs. So the proposed regulations are going to address three really interesting points. One is pledges, and the idea being that you can use a donor-advised fund to fulfill a pledge. The second is the bifurcation of tickets, and this is kind of an interesting one. And I had to do some research on this word bifurcation. It was like, oh my word. But what they're proposing right now is that donors would not be allowed to use their donor-advised fund to make the charitable donation for an event and then pay personally from their own funds for the cost of the meal or the cost of the tangible cost of the event. And so we're concerned, the concern's been raised by a number of folks about, because donor-advised funds are now so abundant, donors need the flexibility to split their ticket and participate in events. And Donna, I don't know if you want to add, but
Sure.
But if people are only allowed to, make a donation and not split the ticket this way, will they come to an event?
Yeah, probably not. And that's kind of what we find some challenge for a lot of nonprofit organizations is that their annual events are the premier opportunity where they are able to share with those donors and those that may be future donors to their organization to really showcase their work. This is the opportunity to do that. Oftentimes you can't have everybody coming to your office or everybody coming to a particular volunteer engagement you might have, and your event becomes that culminating event, kind of demonstrating everything that you've done. So the notion of creating a barrier to that, it's not a good idea. It brings a lot of anxiety as organizations are thinking through that. But then at the same time, we're also trying to work through maybe other creative ways to be able to really engage with donors. But we do think that it's premature to have this as not an option for organizations who have had this as part of their culture and their history for many years. They don't know how to maybe make an about face here. So we're hoping that this doesn't create a barrier and that there will be hopefully some changes to this.
One of the last points I just want to comment, thanks Donna, one of the last points I just want to comment on is the public support test. And when we were in Washington in March with Foundations on the Hill and met with Treasury then, and again when we met with Treasury a couple of weeks ago, this issue of Treasury considering donor-advised funds to be almost like private foundations came up, and it's something that we're concerned about and we're monitoring. And what we realized was that we have to reinforce the fact that donor-advised funds are public charities. They're not private foundations, and they can be counted in a nonprofit or public charities calculation for the public support test. So that's another issue that we're monitoring around donor-advised funds. Well, we're about 30 minutes into our webinar, and I just want to pause there because we're going to move now into one of my favorite words, UBIT. Yes?
Oh, we did have one question before you move on.
Sure.
So Robert asks, I'm still not clear what bifurcation of tickets means. Some dollars to DAF and others to pay for a meal, or better, a different definition.
Oh, great question, and let's try one more time. And if anyone else on the call wants to also chime in on this, please add your comment to the chat room, But let me just explain what I've been told by the people at Treasury. Essentially, what a lot of donors do now is they will essentially split if the ticket for the gala is $100 and $25 of that, no, that's too cheap. Let's make it $250 gala. If it's a $250 event and the charitable portion of the event is $200, what a lot of donors have done is make that $200 distribution from their donor-advised fund and then pay the cost of the meal and the event itself, the remaining $50 from their personal funds. And what Treasury is suggesting now is that they don't really like that policy because they feel that the donor is getting a additional benefit from their donor-advised fund, because in many cases their donor-advised fund may have been established by a parent, a grandparent, another family member, etc. So it kind of gets into this whole issue of unintended benefits. And so what they're suggesting now is that if a donor wants to make a gift from their donor-advised fund, they can, but they don't want to allow them to split the ticket for the gala in that way. But we'll follow up with more information after the webinar on that question, so thank you for asking that. So let's go to the next slide, Andrea. I'm really, Don and I are really privileged because we have so many wonderful, talented tax experts in Michigan. And one of our special tax experts who has joined us for this call is Lori Boyce. Lori is Director of Tax with Deloitte based in Detroit, and she's been there for a number of years, to put it mildly, and she's really also built Deloitte's Michigan Healthcare and Nonprofit Tax Practice. And Lori serves on a very special advisory group, work group with Treasury in Washington on nonprofit tax. And I asked her to join us for this call, and Lori, I'm very grateful you can, because people have said to me, okay, Rob, what is UBIT and what are these new taxes? So, Lori, hopefully you're unmuted and you could join us for a few minutes and fill people in on what is unrelated business income.
Okay, thank you. Thanks for the nice introduction. And I just want to confirm that I am unmuted. Can you hear me?
Yes, we can hear you. This is
okay.
Perfect.
Perfect, instead of me talking and no voice coming through. So thank you. I'm happy to explain what UBIT is and then talk about some of the couple of the provisions that are somewhat controversial with respect to UBIT as a result of tax reform. But in a nutshell, unrelated business income, commonly referred to as UBI, is defined as income from a trade or business regularly carried on that is unrelated to your exempt purposes. Sounds simple, right? Inherent in a trade or business is a profit motive. So if you don't have a profit motive, typically the IRS will say, if it's income, we'll tax you, and if it's not income, well, it's kind of a hobby. Activities such as periodic fundraising rely on the fact that it's not regularly carried on, and so there are going to be other types of examples like that. The calculation of UBI requires exempt organizations to follow the normal tax rules affecting taxable organizations, but is complicated by the need to bifurcate, a term you've already heard a little bit about, income and expenses between activities that are taxable and those activities that are not taxable. In determining UBI, there are certain activities that are generally excluded from UBI, most of which are passive, such as rents from real property, dividends, interest, gains, and income from securities lending. But there are exceptions to those rules. So for example, if you borrowed money to acquire the property, whether it be securities or a rental building, et cetera, then that will become unrelated business income to the extent you've debt financed. And then certain activities are also going to be excluded from income as well. So debt causes UBI. Something that you might get through a partnership investment may generate unrelated business income, et cetera. There are going to be some deemed sources of UBI, which historically included personal property rents, certain income from controlled organizations, and insurance income from controlled foreign corporations. Many of you might not have some of those things, but now with tax reform, I think what will happen, depending on what the guidance comes out with, there will be a lot of exempt organizations that will end up filing a Form 990T for the first time. That is going to be burdensome to the IRS, and it's going to be burdensome to this community as well. So let's talk about that for a second. The first one is the transportation fringe benefits, and also referred to as like the parking and the transit passes. This is probably one of the most controversial sections of the new tax reform affecting tax-exempt organizations, in part because the rules aren't clear, but more importantly because it's going to cause so many people to file returns, and then it's going to be administratively burdensome. So let me give you some examples. The general concept is that if the value of the transportation fringe, in this case parking, is excluded from your employee's income, then the cost of providing such parking is deemed to be unrelated business income. So for example, if your employees pay for their own parking, but they pay for that in pre-tax dollars, then, or if you pay the vendor and provide parking directly, so say you're in the downtown area and everybody pays for parking, well then that portion of what was either paid to the vendor or your employee excluded from their income is going to be unrelated business income. That's an easier example. It's costly, but it's an easier example. Then if you look a little further, but what about if your parking is used for employees, visitors, maybe customers? Well, then how do you allocate that? What about if you have employees that work 3 shifts, like a hospital? Or if some employees carpool to work, and so you don't need a parking spot for every employee. And then what costs get captured? So some of the things that you would normally think would be depreciation, maintenance, snow removal, security, lighting, painting, you kind of get the idea. So if you imagine, you might just have 10 employees, but parking might be more than your $1,000 standard deduction or exemption for unrelated business income. So that can cause small staffed foundations to pay unrelated business income tax that they never did. We don't know yet what the regulations will say, but we've certainly raised these issues and the burden with Treasury and those that will be responsible for writing the regulation. Rob, did you want to make any comments here about what you heard?
I think what you just said was perfect, and could you just take a moment, Lori, and comment on the Form 990T, because most nonprofits have never heard of it, and
okay.
And what I hear from people, and what Donna hears from people is, oh my goodness, we're now going to have to, spend
That's
more.
Right.
As much as we love our accountants and we love our people, so if you could spend a moment on that, and then we should talk a little bit more about these other 3 as well.
Yes. So on what you currently file would be either a 990 or a 990-PF. That is for all your exempt activities, typically reported on your book income with some adjustments. When you get to unrelated business income, there's a whole new tax form you file, and it's called 990T. And what that does is you compute all of the items of unrelated business income, excuse me, and then you report that on that particular form. You pay, if you're a foundation, you pay separately your unrelated business income tax from your foundation excise tax on net investment income. So you'll have then two payments. For those that just filed a 990 and never had to pay taxes before, you may have to make sure you're registered for the electronic funds transfer payment system so you can make your electronic payments for this new tax. But it's a long form because there's a lot of additional schedules which won't apply to most organizations. The form itself, though, because of their process, will not be adequately updated for 2018, which is when these rules come into play. And as a result, you'll need to see supplemental things that are going to be on the IRS website. So 2018 might be a messy year for that. And then once you get the hang of it, this part might get smoother. But I think it's going to cause a lot of complexity in figuring out what you actually have to report, and if you do. We're trying hard, and we've made recommendations to say on this particular one, if you're going to still impose it, could you at least have a de minimis rule and say less than a certain number of employees wouldn't have to do this to eliminate a lot of the small staffed organizations, but we don't know if they will do that. So in terms of the silo rules, which is another concept of unrelated business income. So for those of you that have already filed in the past, you might have multiple activities that have unrelated business activity income. Most of the private foundations are going to be generating their unrelated business income through their investment portfolio, and those might come through on K1, which is the partnership information reporting to its partners. The new rules, before you netted everything together if you were a corporation, if you're a trust, you had some complexities because of the passive activity loss rules, which I think is kind of beyond the scope of this. Most of the organizations are set up as corporations, which is a lot easier. So in the past, you netted everything together. You took your deductions that might be eligible, like your tax preparation fees and your state and local tax deductions that were associated with your unrelated business income. Now going forward and starting in 2018, there is this concept of silos in that you cannot take losses from one trade or business activity and offset income from another trade or business activity. Sounds simple, not easy. How do you define a trade or business activity? And in reality, some of the things that generate unrelated business income aren't a trade or business at all, but are deemed to be generating unrelated business income. So I'm working with a group that's looking to make recommendations and provide examples to suggest, and I think we're getting some resonance with Treasury that they may go along this route, and we're hoping that they do, that at least your investment portfolio would be considered a single activity. If they didn't do that, can you imagine if every K1, and you say you had a couple hundred K1s, was a separate trade or business under these rules, and that you had to track all of those separately? That would be a lot of administration, and it would also cause a significant increase in taxable income if you pay tax on all your income and not on your losses. Now, if you have an activity that has a loss, you may or may not lose the benefit of that. That loss can then, under these rules, be used to offset future income from that same activity. So if you generate income in the future or gain on the sale, for example, then presumably that would offset. However, if you think about something that's debt finance, you only have income that's unrelated business income to the extent of your debt finance percentage. So say you borrowed 50% of the value up front and you paid that debt down over the next 5 years, and then you sold the asset, say in year 7, you wouldn't have had that income would not have been subject to UBIT because you didn't have any debt anymore, and you might not have used the losses that were generated while you did have debt on the property. So I could go on this topic for quite some time, but it gives you a flavor that there is a lot of uncertainty, a lot of complexity that may go with this. But the bottom line is more than likely your taxes will go up because you may not get the benefit of all of your deductions. The other thing that's a little concerning about this is to the extent that you have deductions that are not associated with an individual trade or business, but multiple, like your state income taxes. Do you have to allocate that between your trade or businesses, or is that done on an aggregate basis, and do you get a benefit? Similarly with your tax preparation fees, some of your investment management fees, et cetera. So I'll pause there and see if there are any questions on that particular item.
Lori, this is Rob. Could you just, the nonprofit sector is so diverse, and could you just give us some examples? I mean, for example, I think of like, a number of our universities operate bookstores. We have museums that operate gift shops. We have, the Goodwill that operates multiple sites. Those are all going to be impacted by this new tax, right?
Absolutely. And some will be harder hit than others, and how you define things can have a big impact as well. So, yes, all of these rules apply to everybody, and they will have impacts differently. So your college or university, their bookstore may or may not be taxable depending upon what they sell. But if you have that activity, but then you also have advertising that you sell with respect to your athletic activities, those would be two different activities. And if one had income and one had loss, you wouldn't be able to offset them under these rules. The other question is also if you have, for example, a college might have campuses in multiple cities, and can you aggregate the bookstores, for example, from all of the activities, or are those separate activities because they're geographically in different locations? We don't know, and that's what we're hoping to get some guidance on. And we're hoping that they give some flexibility to organizations to make a determination. So, for example, if you manage all of these activities under a single set of management, same policies, et cetera, even though they're geographically dispersed, is that still a single activity? Maybe. We're hoping that they allow that.
That's very helpful. Could you just, and if anyone wants to ask, I mean, we're very fortunate to have Lori with us today. If anyone wants to ask a question, and I've chatted with Lori, we'll do a follow-up call just on this subject because, and in the next slide you'll see I've got two bullets there. One is that, and Lori, correct me if I'm wrong because you've been working with Treasury on this, but in the priority guidance list, didn't they say that they may make this available by June or sometime this summer?
Yep. So on the UBI silo rules, they're hoping to have something out by the end of June. On the transportation fringe benefits, at one point they said fall, but I'm not sure that that's still the case on that particular one. But a lot of things, there's additional nuances, if you will, that also will impact those because there's other limitations like on business interest expense, deductions and things like that they still have to come out with guidance as well. Interestingly, for 2018, the forms already had to have been developed, if you will, and they haven't figured out the guidance yet. So needless to say, the forms are not going to be reflective of what the guidance comes out to be because the lead time for programming the forms and to develop them, et cetera. So this is, like I said, going to be a challenging year. But they are trying to have had a series of calls. They're very engaged. This is one time where they are begging for input because they are overwhelmed. They're short of people. The short fuse. This came out in December. Normally they have their forms locked down by March for the following year. Obviously that can't happen. They have limited programming resources. So they're trying to do the best that they can. They're coming out with guidance as quickly as they can, but in different means. So they're doing notices, for example, of what they intend to do because at least it gives you something as to what they're thinking. It gives you an opportunity to react. They do have a tax reform page on their website that I encourage people to regularly go there and see what they've posted. If you have specific feedback, they are looking for it. And if you want to funnel that through me, feel free to do so. I'm in the process of getting some comments back to them after we had a series of calls. We're actually writing some examples for them that they could, if they like them, incorporate into the regulations.
And so Lori, that's great. And just on the slide that we're working on now, we'll come back to the last two new taxes, but a number of us were asked by Treasury after we met with them in March. So a number of us have submitted letters requesting a year delay in implementation, which at first Treasury said we can't do it, but then we showed them precedent that they've already done that in the past.
Right.
So a number of us have done that. And then the other thing that you just mentioned, Lori, which is so important, is that Treasury also said to me and several of us that, we'd love to, they all agree that they can't figure out this excessive administrative burden versus the value of the tax. So they said, if you can create some case examples to send us, that would really be helpful. So those are just 3 points that I want to mention there. But before we go into the last 2 points on this slide, let's double back, Lori. Could you just comment, if you would, on the last two, the excess compensation and the new tax on private college endowments?
So with respect to the excise tax on executive compensation, that is a new tax. Part of this is for publicly traded companies, there has been a non-deductibility of large amounts of income over certain dollar amounts, and it's kind of got some nuances on how complicated. Well, in their great wisdom, Congress thought that tax-exempt organizations should have similar consequences, but cause it to be subject to an excise tax at the corporate tax rate of 21%. And what that is that for covered people, and I'll define that in a minute, for covered people, if they have compensation in excess of $1 million, or if they have any parachute payments, then they will be the exempt organization will have to pay an excise tax of 21% on those amounts, the excess over the million and the parachute payments. Covered people is going to be your top 5 highest compensated individuals that you report on your return. So if you file a 990, you're familiar with the reporting there. But it's your top 5 highest compensated, regardless of whether they're over $1 million or not. And they stay on that list going forward until they haven't been around for 5 years. And the next year, if you have different people in those positions, you add to the list. So it can be more than 5 people that is subject to this. There is an exception for people that provide medical services. That was a strong lobby by the healthcare industry. But for others, you can imagine that you might have over $1 million if you've had a long-serving CEO and they've had a supplemental retirement program and now they vested or they get it in retirement, that they could jump over $1 million, even though their income on a normal basis was nowhere near that. These rules are to be applied to the organization and related organizations. And what surprised me in the conversations with Treasury is that there is a comment that they would apply this to related for-profit organizations as well. They probably had gotten wind of the fact that some organizations were just going to put a number of their high compensated employees into a for-profit management company, and that won't get around it. So it will be interesting to see. In terms of how it's paid, it looks like it will be paid on an excise tax form, which is a Form 720, which is new. This is, again, subject to tax in 2018. but we don't have guidance out on that yet, and nor on when you pay that, because you may not know until after the end of the year whether they hit $1 million. That is also based on the income that is subject to withholding. That's how it's defined. So for income tax withholding purposes, plus certain deferred amounts that under like 457 that become vested, that you might not be subject to the income tax withholding at the time, but might be subject to the FICA withholding. So that's the amount of compensation. The parachute payment is effectively something that would be paid for a change in control of more than 3 times the individual's compensation. I think that, one, I don't see in a lot of exempt organizations, they don't have change in control payments. And those that do, I don't see them that high as far as like 3 times. I'd see them more like 2 times, something like that. So I'll pause with that for questions.
So, Lori, just Rob here, 2 questions that I've been asked about this. One foundation said to me, well, I could just transfer my investment staff over into a separate entity and have them work for me that way. But right. what you're saying is that would not be a way to get around this new tax.
Depends on how they write it and how you structure it. So I think I wouldn't make any moves till you see what the regulations come out as, because they're contemplating that. And so they can capture related, and related is typically where you have common control. How they would do that if, for example, these employees were in a separate management company that the exempt organization had no ownership or control over, but was independent contractor, I don't know. If you're the only customer, would that be pulled in? That I'd wait to see what regulations do. Okay, but you're right, the investment personnel are typically the ones that make a lot of money.
Right. Well, a number of foundations around the country I know are concerned about this issue because they like the fact that they've got talented investment folks who make good money but also produce amazing returns, and they've said to me that, well, if we've got to deal with this, we may lose them to Wall Street. So it's definitely raising a concern.
Well, on the other hand, it could be that this is an excise tax that's paid by the exempt organization. So if you don't change their compensation, you're not necessarily going to lose them, but your cost is now a much higher because you've got this tax to pay. Yeah.
Right.
Yeah. So on the endowment funds, this came about because there are some private colleges that have huge amounts of endowments and don't necessarily distribute them. And so they, in writing these rules, they were looking to impose kind of a penalty on that accumulation. And so they've done this to say that if you have over so many students, and if your average endowment is over like $500,000 per student, then and it's tuition-paying students, that you would pay an excise tax on effectively the net investment income. So similar concept, but it's there to capture those foundations that are endowments for private colleges that have accumulated a lot of money. This doesn't apply to the public colleges, but it does apply to the private. And because of some good lobbying by Hillsdale College, it's now for tuition-paying students. So if you don't charge tuition, then you're not subject to this either. So that's in a nutshell what that excise tax is about.
Lori, this is incredibly helpful, and let me just remind people that we'll do follow-up to, once guidance comes out, but if you have any questions of Lori, we'll make sure that we, this is a good time to ask them. But also, Lori, I think one of the concerns that I've heard about is that this new tax on private college and university endowments really represents the first of what could be additional taxes on endowments. That, endowments are kind of now on the radar screen in Washington, and so I know that that's one of the reasons why both Donna and I are concerned about this, because it kind of sets the wheels in motion. Have you found any?
I think.
Go ahead.
Yeah. When this tax bill was first proposed in the House, and I read it, I have to admit I got really angry because it was very mean-spirited to nonprofits as well as people who are less advantaged. And it did evolve over time, but it's clear that the current Congress is not as supportive of nonprofits as you would expect. And so I think, in part is that they hear about, for example, the college coaches that get paid a lot of money. You hear about these endowment funds. They're just adding funds and not distributing. And so I think there's they hear those kind of stories that you might say are the bad apples. And as a result, they start focusing on that and viewing that as the industry. So I think the industry has to do a good job of really, as you mentioned earlier, for the charitable purposes and the donor advised funds, similarly to try to mitigate future adverse tax consequences, to really help them understand all the good things that most charitable organizations do, and that these types of organizations that are not distributing, accumulating funds, and really not doing as much social good and paying people, except what they view as excessive amounts, I think that you've got to mitigate those stories. Because if you recall back in the 60s, you didn't have the concept of private foundation, but because there were a bunch of bad apples at that time, they came up with all those excise taxes on self-dealing and excess business holdings, et cetera, because of the bad apples. And so I think we're in that kind of environment right now that you really have to get the story out for the masses so that the narrative isn't controlled by what they view as the bad apples.
Got it. Thank you, Lori. Andrea, has anyone asked any questions of Lori, comments on the chat line?
Yes, we had one question, and that was, would fees charged for entrance to a property owned by a private foundation be considered UBI?
I'm assuming that's related, is the question related to the parking or just a general UBI question? Can we tell from the chat? So I'll try to answer in both regards. So if you have an exempt activity and you charge admission, go ahead.
If there was clarification related to entrance fee or parking.
Okay. So if you have an entrance fee to, for example, a zoo or a museum, and it's for access to the exempt activities, then no, that's not unrelated business income. That's part of your exempt purpose, and it's fine to be charging for it, just like a hospital charges its patients. When you charge for parking, there is an exclusion from UBI income if that is that's for your visitors and your customers. That's okay, and that's not going to be subject to unrelated business income. If, however, you have a parking lot that's in an urban area and anybody can park there, and you have people that are going to like a neighboring shopping mall or whatever, then that portion would be unrelated business income. So again, that bifurcation type of concept, you need to understand who's permitted to use it.
I think those people that get involved in signage are going to have a field day with parking lots explaining this once guidance comes out. Andrea, any other comments or questions for Lori? We want to go to our next slide, just two other last points on this slide before we get into the opportunity zones.
No other questions.
So Lori, can you just help me out on what we've heard about is that there is discussion that because this was the fastest 45 days of tax policy sausage making, that there may be efforts in Congress to do what they call technical corrections.
Yep.
And when we met with the House Ways and Means staff in March, I remember this one young man looked at us and said, "Oh my goodness, you mean we may be generating all these Form 990Ts? That wasn't what we had intended at all." It was like a marvelous revelation. But do you want to just comment on that?
Yeah. So they did, as you mentioned, this went through very different than normal bills. This went through very rushed. It didn't get vetted. Normally there's drafts out there. The public can comment. They can revise it before it gets enacted. That didn't happen. They also didn't consult with the IRS in terms of whether any of this was administratable. And even within the bill themselves, they went so fast that their explanations and then what they drafted as legislation, in some cases, totally contradicted each other or didn't do what it was intended to do. And so there's an awareness that there's fixes that need to be made, probably more than normal, because in any tax bill, there will be mistakes and technical corrections will come. Because this was put through in the manner that it does, and as we know, our Congress is very partisan at the moment, the process for getting any technical corrections through will require 60 votes in the House. That's the expected process. What the Democrats have said is that we've rushed this too fast. We agree technical corrections make sense, but we want to take our time and get it right. So this is going to be months before anything would be put forward. I understand that the list right now is very short in terms of what is, quote unquote, on their list for technical corrections. Things are still being vetted. And I also think that a lot of this bill was written so complex and it's taking a long time to really uncover all of the issues. And we'll find more issues coming as we dig deeper and deeper and deeper into this bill. But I do expect there will be technical corrections. There's also supposed to be kind of what we call a blue book coming out that explains some of the provisions, but I don't know what timing that will have.
Lori, thank you so much. So, you know, you've all just benefited from, I mean, we are so blessed to have a Lori Boyce in Michigan. And Lori, thank you for your advice. And we'll do some additional follow-up with your help once we get this guidance moving out of Treasury. And we're grateful that you're helping provide them with expertise as well. Before we go on, because we do want to talk briefly about the Opportunity Zone activity that really does present a new opportunity for Michigan in the bill. I just want to ask Donna to comment on the issue that was originally tied to this tax act, and we found in the Senate a new friend, the Senate parliamentarian, and that is the repeal of the Johnson Amendment. Those of us that were on the Hill in March, this was an actively discussed issue, and in December when the bill was being considered, you know, we knew that Senator Stabenow and Senator Peters on the Senate side were both very involved in helping us avoid repealing the effort to repeal the Johnson Amendment. So, Donna, why don't you chime in?
Thank you, Rob. So we were very excited when it didn't show itself in the tax reform bill. However, there was a bit of nervousness that occurred when it was the time for the omnibus spending bill. And so we were really hoping that we won. We didn't have to worry about the repeal of the Johnson Amendment. But then we got word from a national level, especially through our friends at the National Council of Nonprofits who have been working diligently to make certain that the Johnson Amendment stayed in place. We found out there were lots of people who wanted to oppose this and really wanted to have that repeal. So there was lots of energy around repealing that and for it to possibly occur during the spending bill. So luckily, as an update, we did not get repealed during the process of the spending bill, but we do believe that it would probably rear its ugly head because the opposition is strong to repealing the Johnson Amendment, that we'll probably have to revisit this again in 2019 as we look at the spending bill. So for right now, we're good. And we made it past the tax reform, we made it past the spending bill, and now we're just making certain that we brace ourselves for possibilities to occur in opposition to that next year.
So Donna, just remind everyone, what does the Johnson Amendment do? Just so everyone is reminded.
So the Johnson Amendment is really the charitable sector's friend in that it makes certain that we're not in a situation where we are politicizing the nature of our work. It keeps our work focused on what our work is and not necessarily engaging at all in bipartisan politics at all. So we have enjoyed the trust of communities to be able to do our work with not having to worry about being in politicizing our work at all. And this has been something that has that not only that we've enjoyed it, but we've been able to gain the community trust and focus in on really fixing and challenging some of the wicked problems that exist in the world. And so we want to keep that. And the repeal of that, there are so many things that could happen if that were repealed. And at this point, we're lucky that we have not had to experience that this year.
Great. Thanks, Donna. So the last thing we want to mention, and Lori, if you have any comments on qualified opportunity zones, please chime in on this issue as well. Much to our delight, we found that there is a new opportunity that's being provided in this tax act, and that is qualified opportunity zones and qualified opportunity funds. And the governor, each governor had to submit the census tracts from their states that met certain poverty guidelines for HUD and for Treasury. And so Governor Snyder did submit, with the help of MSHDA and MEDC, a list of about 283 census tracts in Michigan, which have now been approved by Treasury as qualified opportunity zones. And so we're going to, and I think there's a link that, Andrea, do you want to just comment? Have you just put a link up on how they can find the census tracts in Michigan?
Yes, so there is a link in the chat box, and that will take you to the MSHDA website, where you can look at the opportunity zones, and they are designated in the different prosperity regions.
Thank you. And so more guidance is coming on this, but the thing that's interesting is that we now have a new tool called a Qualified Opportunity Fund, a QOF, and investors can defer gains on the sale of appreciated investments if they're invested in this new tool, in a qualified opportunity fund in a qualified opportunity zone. And the folks at MSHDA and MEDC are quite excited about this. And now that our census tracts have been approved, I've been told that we will be getting more material, more information from MEDC and MSHDA about what this means for folks. So as foundations and as nonprofits look at these key census tracts, I think there's going to be an opportunity to reach out to private investors to look at partnership opportunities here. Lori, has this come up in any of the conversations you've been part of with Treasury? And any guidance you want to offer us on this?
No, we haven't had a focus on this with them at this point in time. We've had some other priorities, so apologize.
I agree. Great. Well, thank you. And so I just wanted to make sure everyone knows that this is coming. It's a new opportunity for key census tracts in Michigan that have now been approved by Treasury as submitted by Governor Snyder. So as we wrap up our webinar, I just want to, let's just take one last request. Anyone have any comments, questions? We're going to be doing further webinars once guidance comes out from Treasury. Hopefully in June next month, we'll get some guidance on some of these new taxes. And as you think about grantees that your foundation works with, Donna and I have talked about M&A and CMF, providing some more resources for you to share with your grantees, because I got an email from a nonprofit in Lansing that said, Rob, I've been providing parking assistance for my 20 employees forever, but I've never heard of unrelated business income. What do I do? And so clearly for our nonprofit sector, we're going to need to provide more information, and with help from folks like Lori, we'll be able to, get the job done. So stay tuned on that. But anyone have any additional comments on the chat line that we want to address today?
We had one additional question, and it was about the opportunity zones. Does this present an opportunity to invest portfolio funds in qualified local investments and not have to be concerned about UBIT?
Heck of a good question. The short answer is I believe it does, but we're going to need to provide more guidance on that. So it's a great question, and stay tuned. We'll follow up with a more detailed answer to that question. That's a very good question. We'll follow up for sure. Well, let me just do a brief commercial. As all of you know, the Council of Michigan Foundations has an annual fall conference, and this year we're going to be doing our 46th annual conference in Grand Rapids, October 7 through 9. And the theme that the program committee that represents foundations from all over the state has come up with is Igniting Ideas, Sparking Change, Philanthropy on the Move. And so we're excited about the theme, and the conference committee has been busy coming up with some great sessions, great speakers. And October 7th is a Sunday, and it's the last day of Art Prize, so we're going to be opening the conference at a phenomenal Art Prize venue 5 blocks from the Amway Grand called the Fountain Street Church. It's an amazing venue, and we'll be opening there on Sunday evening at 6 o'clock. So I just want to make sure you save the date on your calendar, and obviously you'll be hearing from CMF and M&A about more on tax policy as we get guidance from Treasury. And Lori, again, thank you so much for your help today, for joining us in the discussion, particularly on UBIT. So we really appreciate that. Andrea, we need to have everyone do evaluations, right?
Yeah, so everyone will receive an automated evaluation in your email. So please be sure to follow that link and provide feedback. It's a short evaluation, and we'd really appreciate your feedback. And there's opportunities to add those additional follow-up requests or any comments that you have about the program in that form.
Thank you so much. So Donna, thank you again for your partnership, and for all of you on the phone and on this webinar, thank you so much for joining us today. And don't hesitate as you think about all of this information, and if additional questions come up or need for clarification, like the question that was just asked on opportunity zones, we want to make sure we respond, so don't hesitate to let us know. We're going to give you back 14 minutes and adjourn early, which I love to do, Donna. This is good. So Donna and I both give you a round of applause. Thank you so much. We're adjourned.